All right, let's jump right into it. Today, we're breaking down Hancock Whitney's fourth quarter 2025 earnings report, which just dropped on January 20th, 2026. So, what's the story here?
Well, right off the bat, you're looking at a real tale of two numbers. On one hand, the company managed to beat earnings per share estimates, but we're talking by a single penny. And on the other hand, revenue came up short by more than $2 million. So you've got this immediate tension, right? A classic mixed bag.
And you know what? The market did not waste any time picking a side. Investors zeroed in on that top-line miss, and in after-hours trading, they pushed the stock down nearly 2%. A pretty swift reaction.
So this is the key question, isn't it? Management sounded pretty upbeat, but the market's reaction tells a completely different story. That's what we're going to unpack today. Let's dive in. Okay, first things first. Let's get a really clear picture of how Hancock Whitney's performance stocked up against what Wall Street was expecting. So here are the headline numbers. You can see that 1 cent beat on GAAP EPS coming in at $1.49. Right below it, though, is that $2.2 million revenue miss. But, and this is a really big but, if you look under the hood, there are some real signs of strength. Net interest income, that's the bank's core profit from lending, was actually up 1% from the last quarter, and annualized loan growth was a solid 6%. That tells you the core banking engine is still humming along. Now, in response to all this, management didn't just show up with the numbers. They laid out a very clear, very proactive strategy for 2026. They're actually framing it as a self-help story to drive their own performance. Their plan really boils down to 3 core things. First, they're doing a major overhaul of their bond portfolio. Second, they're going on an aggressive hiring spree to bring in 50 new revenue-generating bankers. And third, they're going to keep returning capital to shareholders through share buybacks. The real centerpiece of this whole strategy, the most immediate lever they can pull, is that bond portfolio restructuring. And get this, they didn't just talk about it, they already did it. This all went down in the first 2 weeks of January. And the impact of this move was, well, it was huge. The bank sold off $1.5 billion of securities that were yielding a pretty meager 2.49%. Then they turned around and reinvested that cash into new assets yielding 4.35%. I mean, that is a powerful, immediate upgrade for their entire asset base. So what does this actually mean for the bottom line? Well, the projected benefits are really tangible. Management expects this single move to add $24 million to net interest income, boost their net interest margin by 7 basis points, and, maybe most importantly, add a full 23 cents to their annual earnings per share. This is a powerful, self-directed earnings driver for the year ahead. And you could really hear that confidence in management's tone on the earnings call. The CEO, John Hariston, put it plainly. He said, "We are very optimistic. We are positioned well for a successful and growing 2026. He's clearly confident in the setup. Okay, so if management is this optimistic, why on earth did the stock sell off? Well, that brings us to the other side of the story, the market's perspective. Right. Despite this very clear strategic plan and the obvious benefits from the bond deal, investors keyed in on the risks and, frankly, the results they just saw. For the market, the story was pretty simple. That revenue miss was the dominant factor. It just signals potential weakness in their core earning power. Second, their entire guidance is based on the Fed cutting rates twice in 2026. If those cuts don't happen, their margin projections could be at risk. And finally, you've got execution risk. Hiring 50 productive bankers in this market, that is an ambitious goal. All right, so with both narratives on the table, management's self-help story and the market's skepticism, let's step into the analyst chair and lay out our take for the next call on Hancock Whitney. The crucial thing here is balancing these two views. The bull case is clear. That bond deal gives them a tangible earnings lift. Their capital position is rock solid at 13.66% CET1, and credit quality is under control. But the bear case is just as straightforward. That revenue weakness could stick around, the hiring plan is a huge question mark, and their whole forecast is sensitive to what the Fed does next. Before we give our rating, let's just quickly define the term. Market perform suggests that we expect the stock to trade right in line with its peers, or a relevant index, not significantly better and not significantly worse. Looking ahead to the first quarter of 2026, we're actually calling for a modest earnings beat. The math behind that bond portfolio restructuring is just simple and powerful, and it should provide an immediate tailwind to the bottom line that might just surprise investors. However, we think the stock itself will probably stay range-bound.
That positive kick from the bond deal will likely be canceled out by the market's ongoing worries about revenue growth and execution risk. It creates this kind of tug of war that keeps the price stuck somewhere between, say, $65 and $72.
And that brings us to our final rating, market perform. Hancock Whitney pulled a really significant lever to support its earnings. But those bigger questions about sustainable top-line growth are going to cap the stock's potential until they can prove that hiring strategy is paying off. The self-help story is compelling, but the headwinds are just as real.
This is not financial advice.